Hi, do you know even if the stock price doesn't move, you can still profit by trading options? If you combine selling put and call options, you can define a range that the stock prices can move while still make a profit. Today, Slash Traders will show you how to use the option scanner to find high probability and high profit strangle option strategies. We'll talk about 4 key points today. 1. What is the strangle option strategy? 2. What are the key points to profitable strangles? 3. Option scanner settings to find the best strangles opportunities. 4. The best strangle options right now. A strangle option strategy works by selling a put and a call to define a range you can profit from. As long as the underlying price does not exceed or drop below the strike prices of put and call before expiration, the two options contract will depreciate in value and we profit as an option seller. Let's recall the profit analysis of selling OTM put and OTM call options. We receive a premium when we sell the out-of-the-money call if the underlying price doesn't increase. The call option value will depreciate and we earn a profit. But if the stock price increases beyond the call strike, the maximum loss is infinite. We also receive a premium when we sell an out-of-the-money put option. If the underlying price doesn't drop, the put option value will depreciate and we earn a profit. But if the stock price decreases below the put strike, the maximum loss is also infinite. When we combine selling an OTM call and an OTM put, we get a strangle. The put strike defines the lower boundary of the price movement and the call strike defines the upper boundary. If the underlying stock price doesn't move beyond the boundaries, the strangle will be profitable. Let's look at some key points to trading profitable strangles. When selling strangles, we want both theta and vega to depreciate the option prices, so we can sell high price strangles to open and buy low price strangles to close. Theta is the changes to options value with respect to changes in time. From our experience, selling options with more than 30 days to expiration have a predictable time value decay, and the gamma risk is lower, so we can be patient and earn a profit as time passes. Vega is the changes to options value with respect to changes in IV. Since we want to sell high and buy low, we need to sell to open at high IV, then buy to close when Vega causes the options value to decay at lower IV. We also need to find underlying opportunities with underrated volatilities. We can do that by picking stocks with price trends that rarely exceed Bollinger Bands and also stocks with high market capitalization to reduce the risk of manipulation. The option scanner is designed to find high probability and high return strangles in seconds. Here are some tips to using the filtering function to find the best strangle entry points. We want to choose opportunities with greater than 30 days to expiration to get the safest theta decay. We can filter IV perk to be larger than 67% to find opportunities that have a high chance of contracting IV and Vega in our favor. By choosing market cap larger than $10 billion, we can avoid choosing stocks that can get manipulated and explode like GameStop. A good idea is to eliminate stocks with depressed price movement because IV will likely expand soon after. So we need to choose squeeze status as false. To further reduce risk, we can even limit the strangle buying power to less than $1,000 so we can easily diversify our portfolio. Finally, we can sort the strangle's return on capital by descending order to get a short list of highest return strangles. Here are our favorite filter settings on the option scanner. And here's the list of the safest and highest return 20 delta strangles at the moment. So we have a short list of the safest and high return strangle options opportunities. We can fine-tune the selection to get the best entry points. You can see the fair value and earnings date for every underlying. If the fair value is very close to the strikes listed in the strangle details, we can be even more confident that the strangles will be profitable. Earnings date is an event that can cause large price movements, so we want to avoid selling neutral option strategy past earnings date. We can see the top 3 stocks with the highest return have upcoming earnings, so selling strangles for them are quite risky. Instead, we can look at selling strangles to Snap. Even though the fair value is a bit low, it is a stable company with a strong business model. We can sell to open a strangle for Snap that expires in 40 days. If Snap's stock price does not exceed the put and call strike prices before options expiration, it has a 27% maximum return. Now you know how to use the option scanner to filter high probability and high return strangle options. Remember to use the scanner often to find the best neutral trades to sell and profit from the lack of price movement. If you enjoyed my video about trading options, please like and share my videos and subscribe to my channel. Thank you.